House Minority Leader Hakeem Jeffries speaking on the floor of the House. Romaine Bostick here with an eye on Washington and an eye on the markets, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick, and this is The Close.
Yep, I'm Alex Steele, and we're kicking you off to the closing bell. What a change it is from today versus yesterday. Let's take a look at what we're looking at in the markets. You got the S&P, a whopping 1% rally, really led by tech. The Nasdaq is up by 1.6%. But it's not just tech, Romaine. It's also other areas of the market, like the Russell and like big caps as well, all outperforming today.
A nice punctuation here to end the week with big tech doing what it does best to try to keep this rally going here in 2025. But here's a question for you, Alex. That 10-year yield, is that going to end up being trouble for stocks this year? Yield started last year below 4%. They started this year above 4.5. That's even after the Fed cut those short-term rates. Nick Colas over at DataTrek, Julian Emanuel over at Evercore separately warning that 5% now the level to watch, with Colas saying that 10-year Treasury and big tech stocks, they're actually going to have to share the stage as financial market co-stars here in 2025. And while the easy gains for tech stocks might actually be over, the rally itself can continue. At least that's according to Salita Marcelli, CIO of the Americas over at UBS Global Wealth. She cites, that heavy AI-related CapEx that supported the rally last year, and says the upcoming earnings season could potentially detail even larger investment plans. Microsoft President Brad Smith, just moments ago, writing in a blog post that the software giant is going to spend $80 billion this fiscal year alone building out data centers to support that AI revolution, and that might support earnings growth as well. So while big tech and treasuries may share the stage in 2025, we were remiss in not pointing out that policymakers in Washington lingering just behind the curtain. A last-minute move today by outgoing President Joe Biden to block that Nippon Steel takeover of U.S. Steel, an incoming Trump administration that's promising to put the screws to big tech, and a divided Congress, at least for right now, Alex, is finally finding some degree of unity, at least on one side of the aisle, to re-elect a new speaker. And that's the old speaker, Mike Johnson, keeping his job at least for the next 2 years.
And we'll bring you comments from Mike Johnson as he brings them here. Let's get back to that original point that Romaine was talking about. So the two co-stars for the markets this year, yields as well as stocks. So here's the deal, right? Stocks boil down to yields boil down to the Fed boils down to growth. And this is where this chart comes into play from Torsten Slok over at Apollo. Now, he hypothesizes that Fed cuts and other developments like inflation expectations, monetary policy, FX, and the VIX will actually add 1 full percentage point to GDP in a year here for the U.S. economy. Obviously, if that's true, that means the Fed can't cut. The terminal rate moves a little bit higher. Ira Jersey said it's actually been that rise in terminal rates, Romaine, that has been responsible for that long end continuing to rise. If that happens, as you point out, we get to that 5%, then how do stocks continue to perform?
And of course, a lot of folks in the bond market right now trying to find value in a similar way that folks in the equity market are trying to do so as well, though. Different reasons and different places to look. Jay Berry joins us right now to kick us off to the close here on this Friday afternoon, head of global rate strategy at JPMorgan. Great to see you here in the new year, Jay. Is this going to be a good year, you think, for Treasury investors?
Romaine, good afternoon, and thanks for having me on. I think it's going to be an okay year for Treasury investors. I think as a starting point, certainly as you talked about from where we were a year ago, we're not pricing in the immaculate disinflation we were. But there's a pathway for the Fed to continue to lower rates at sort of a more moderate pace than it has been. And we envision over the course of this year that given that backdrop, and we are forecasting quarterly cuts through September, that this should mean there's room for Treasury yields to decline. But I think you need to be careful where you're positioning for lower yields. And we think it's more likely the front end, which is much more sensitive to policy expectations, has room to outperform versus the long end where inflation expectations being anchored at higher levels, larger budget deficits and a larger stock of debt outstanding all support long-end yields remaining higher for a longer period of time.
I know it's hard to forecast things because obviously no one really knows what's going to happen. But this year seems to be particularly different, given the new Congress, given the new presidential administration, and of course, a lot of talk here about that rise that we've seen in debt servicing levels, deficit levels, and of course, the promise, at least on the campaign trail, that that would be addressed this year. If it is addressed, that's going to have major implications for where rates go.
I think it certainly could. And in our baseline, we do sort of appreciate what the president-elect has in his platform, but we think the ability to structurally deal with the deficit is going to be limited. And hearing, Congressman Jeffries on the TV just before this talking about Medicare and Social Security and things like that. Mandatory spending is such a big part of the U.S. budget deficit that if you're not dealing with that, it's going to be tough to wring the savings that the new administration is talking about, which makes it really tough for us to think that the budget deficit is going to be much smaller than 6% of GDP in the coming years.
We are looking at live shots of Mike Johnson. He is speaking currently in the House of Representatives. We'll bring you some of those comments over the next few minutes. Hey, Jay, before we get to that, though, does all of that mean that 5% on the 10-year could be a reality for this year?
I would never say it's impossible, Alex, but I think when we got to 5% last fall, in the fall of 23, the Fed was threatening to hike from higher rate levels, and we were going through an open-ended series of increases to Treasury auction sizes. Right now, the Fed's asymmetric bias is to either ease further at a gentle pace or to stay on hold, not to hike further. And while Treasury supply is a going concern in the background, we don't see increases coming until much later this year. So I would never say never, but I think the bar for getting back to 5% is higher than it was, or higher than it's been in the past.
But Jay, then how do you square something like the ISM manufacturing data that we had, right? At like a 9-month high, you had new orders jumping, you had production jumping. The only negative there was the employment actually rolled over a little bit. How do you justify that with yields not moving materially higher?
Well, I think we've been coming off of 3 straight quarters of about 3% growth. And you're right. I think the employment components matter. First, ISM manufacturing is still sub 50, and the employment components weakened. And I think what we've seen in the employment data is while there's not really a pickup in layoffs, hiring has slowed. And I think it's discernibly slower than it was a year ago. So if that's the case and the labor markets are looser than it were a year ago, it's hard to sort of envision, unless it's sort of a labor market that tightens, 10-year yields getting back to those same sort of levels purely from a monetary policy perspective.
All right. We've been talking a lot, Jay, about American exceptionalism. We're heading into a year now where we kind of have mapped out what we think the Fed is going to do. Does it matter that the Fed might be doing things that other major central banks might not be doing, and more importantly, might not be capable of doing?
Romaine, we think it's another year of divergent policies globally. And you're right, American exceptionalism remains the theme. It's hard to identify the vulnerabilities in the U.S. economy. And then we've got a new administration that is likely to focus on extending the tax cuts and implementing tariffs elsewhere globally. We do think it means that the U.S. continues to outperform. And I think it's why we look at the Fed easing by another 75 basis points this year. It's very different than the Euro area where we have the ECB easing to 1 3/4 by the latter part of the summer. And is very different from, say, Japan, which is going through its own policy cycle and actually expected to raise rates. So with the economy strong and some of the trade policy expected to be directed at rest of world, it does make the case for another year of U.S. exceptionalism. And we can see that through the lens of policy expectations.
All right, going to have to leave it there. Jay Berry, head of global rate strategy over at JPMorgan. Yields across the curve today up about 4 basis points as we get down to business here on the close, counting you down to those closing bells. And everyone in Washington right now getting down to business as well. The House of Representatives have voted to re-elect Mike Johnson as Speaker of the House. And now they continue on with the business at hand. Let's listen in to Speaker-elect Mike Johnson.
Exactly, almost. He said this: "We best serve our own country and most successfully discharge our obligations to humanity by continuing to be openly and candidly, intensely and scrupulously American." I love that. I love that. Today, yeah, that's right. That's an applause line. Today, my friends, our nation is the envy of the world. Why? Because we have been marked by a spirit and a people who are explicitly that. We are explicitly American. We don't try to be like other nations, and we recognize that a strong America is good for the entire world. And everybody around the globe knows that. That's right. We also recognize that the core principles that made America what we are must still be preserved today. The principles, I call them the 7 core principles of American conservatism, but it's really the 7 core principles of the nation itself. Individual freedom, limited government, the rule of law, peace through strength, fiscal responsibility, free markets, and human dignity. These are the ingredients, the things that made us who we are. And in America, we know that human flourishing is best achieved by adherence to time-tested truths. We could list a number of those simple truths. Here's a couple. It's better to give a hand up than a hand out. That innovation thrives when bureaucracy dies. The simple truth that it is parents and families and not administrators that must be in charge of their children's education. The path of prosperity has long been paved with policies that put America and Americans first. And that is what we will champion in the 119th Congress. We have a mandate, and that was shown in the election cycle. The people want an America First agenda. They do. Sadly, for the past 4 years of divided government, too many politicians in Washington have done the opposite. Open borders and overregulation have destroyed our cities and stifled innovation. Inflation and weak leadership have left Americans poorer, and they have placed our country in a perilous position. That's right. But in recent months, we've witnessed something happening, something that's really remarkable, a political moment in our modern history, a groundswell of Americans from every state, race, and religion who now demand that we put the interest of Americans first again, and we will, and we will. This is a powerful new coalition of our country. It's a coalition that insists that we purge the policies of America last and we bury them in the graveyard of history's mistakes, because it was a big mistake. To that end, this Congress will renounce the status quo and we will listen to the voices of the people. We will act quickly and we will start by defending our nation's borders. That's the number one priority. Yes. In coordination with President Trump, this Congress will give our border and immigration enforcement agents the resources that they need to do their job. We will secure the border, we will deport dangerous, criminal, illegal aliens, and finally finish building the border wall. You said you'd work with us on that, Hakeem. I'm counting on it. After 4 years of high inflation, we have a big agenda. We have a lot to do, and we can do it in a bipartisan fashion. We can fight high inflation, and we must. We'll give relief to Americans, and we'll extend the Trump tax cuts.
You've been listening to current U.S. House Speaker Mike Johnson and currently re-elected House Speaker Mike Johnson speaking of the U.S. exceptionalism, U.S. first agenda, now talking about bipartisan work to bring inflation down. Joining us now with more from Washington, D.C. is Balance of Power co-host Joe Mathieu. Joe, what did we learn in the last few hours about how things could run in Congress?
Well, we learned that it's not going to be easy for the gentleman we're looking at here. Speaker Mike Johnson is no stranger to having a thin majority, but it just got thinner. And if Donald Trump gets the members of the House he hopes to be a part of his incoming administration, Mike Johnson is going to have a majority of one, not unlike the vote that we saw for Speaker when he could only lose one vote. That's going to be the case for a lot of pieces of legislation. It's going to have a lot to do with how he works with Hakeem Jeffries, who, of course, he was just referring to there in his speech when it comes to things like the border, extending the Trump tax cuts, et cetera. I will say that there is a tenuous majority as well, not just a thin one. We saw two members change their votes to make this happen. There is reporting that they were both approached by Donald Trump to do so. There was some interesting backroom talking going on here. And one of the holdouts here, actually Ralph Norman, a member of the Freedom Caucus, just signed off on a letter with several of his colleagues, making it clear that this is not necessarily an easy path. It says, today, we voted for Mike Johnson for Speaker of the House because of our steadfast support for President Trump and to ensure certification of his election. That, of course, is set for January 6th, Monday. Yeah. We did this, it reads, despite our sincere reservations regarding the Speaker's track record of the past 15 months. Yeah. So stay tuned. The hard part actually starts.
Well, that's what I'm curious about, Joe, and I don't want to rain on Mike Johnson's parade. He deserves a few minutes to celebrate here. Would this re-election have happened, or would it have happened this quickly if we weren't actually up against an electoral college certification on Monday?
It's a great question. You're putting your finger on the point of leverage that Mike Johnson did not have in past elections. He's been through this, of course, already once, and certainly Kevin McCarthy did not have last year. When Donald Trump picks up the phone and says, hey, I expect a joint session to be ready on Monday to certify my vote, that actually carries some weight, certainly with these MAGA loyalists who are in the Freedom Caucus, who have a lot more to say about Donald Trump than they do right now about Mike Johnson. You're right, though, Romaine. We should let this breathe for a moment. The first day of the new Congress is a great day in Washington, and when he's done speaking, he will swear in all of these members to start the 119th.
Also, Joe, didn't it take Kevin McCarthy 11 or 15 tries to get speaker?
50.
This happened in technically just one. So I appreciate that he only has a majority of one, but it still went through in a relatively timely fashion, no?
You could say that, sure, but it took some cajoling, and to actually see them hold members on the floor so people could have arms twisted to change their votes says a lot about what's going on here. A majority of one is going to be a lot more difficult. That he at least had a few seats to play with in the last Congress. The 119th is going to come with an incredibly thin majority here. But look, he also has the power of Trump, and maybe that makes his life easier. These are the things we're going to be waiting to see. Both Donald Trump and Elon Musk endorsed him late in the game here. And if you have both of them behind you right now in the Republican conference, that's pretty powerful.
Yeah, you wonder, though, are they behind him or standing in front of him, Joe? And that's going to be a big question. Probably the most interesting stat that I saw was out of Billy House on the slim margin coming in here. The slimmest margin of control that either party has had following an election since 1930. Challenges ahead. Joe Mathieu and the team over at Balance of Power will continue to cover this for us here on Bloomberg Television. Meanwhile, when we come back, we're going to refocus here on the markets as we continue to count you down to the close. A closer look at some of the big movers on the day, and that includes Bumble. Wolfe Research downgrading the stock. We're going to talk to the analyst behind that call. Coming up next, this is The Close on Bloomberg. All right, time for a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start today with JPMorgan. Wolfe Research upgrading the stock to outperform. The analyst setting a new price target as well of $269, saying recent share gains are, quote, unmatched. And the bank's guidance on net interest income is conservative. He says JPMorgan is a way to play both quality and defense in this market. Those shares up for another day by 0.9%. Next up, Las Vegas Sands. Jefferies raising its recommendation on the casino stock to buy, citing the company's sector-leading balance sheet and upgrades in Macau and Singapore that should bolster the bottom line. Overall, Jefferies sees pockets of growth in the U.S. gaming sector as well, and those shares moving higher by about 0.9%. And finally, let's take a look at Bumble. This is another call from Wolfe Research. Swiping left on the dating app as they cut their rating to peer perform. The analyst actually saying that the recent exit of the CFO, rising competition, slowing industry growth, all key risk factors, and Bumble will likely underperform the market in 2025, given some of those challenges. Those shares, though, bucking the trend, up about 1% on the day, but at 807, well below its highs of recent times. Those are some of our top calls, and we're going to stick with that last one there because I'm pleased to say that the analyst behind that call, Shweta Khajuria, joins us right now, Global Internet Managing Director over at Wolfe Research. All right, so is this a Bumble-specific downgrade, meaning are the problems plaguing Bumble sort of all of their own making, or is this more about industry-wide trends when it comes to how we use dating apps?
Well, first of all, thanks for having me. I guess to answer your question, it's both, but skewed more towards Bumble specific, and I'll explain why. When we think about industry growth, which is driving part of the reason behind our downgrade, there is some concern around social media competing for time spent across Gen Z. Gen Z's preferences and perception of online dating is changing rapidly, and industry is increasingly getting saturated in terms of online penetration levels in developed world at around 50% or higher. And when that happens, growth invariably starts to slow down. And in addition to that, competition within the industry is also significantly higher today than it was perhaps 10 or 15 years ago. So those are the industry dynamics that are working against Bumble. But then there are increasingly Bumble specific issues that include misexecution or change in product strategy that will take some time to prove out, and there is execution risk. Second is the CFO leaving, and that leaves, based on our channel checks, questions around the morale of the company and creating a distraction for the management team up in the first quarter of this year. And then the third thing is also around their communication overall, having the management team cut their guidance in 2025, and then there's very limited visibility in 2026 and 2027 around their product pipeline, as well as how needle moving the reset is to begin with. So all that put together, again, irrespective of how the stock is trading today, there will probably be trading opportunities in Bumble stock, but maybe not seen as an investment asset.
So, Shweta, it's the same thing, but like different when it comes to what you did with Chewy today, too. You cover so many consumer stocks. You upgraded the pet product retailer to outperform, and that's sort of an industry-wide, but also very much a Chewy-specific story.
Absolutely, yes. And I guess investors are liking the upgrade more than the downgrade based on the stock reaction. But again, irrespective of the stock reaction, here with Chewy, it is a bit of both. Like you called out, macro-driven. Chewy is very sensitive to macro. And up until now, we have seen Chewy being pressured from macro headwinds because of the household pet formation has been muted. And now we are kind of starting to see green shoots. But more importantly, what Chewy's management has specifically done around its platform, for example, product initiatives around advertising. It's only 1% of their overall business, and that can grow to 3% fairly quickly. And we've seen this with eBay, we've seen this with Etsy, we've seen it with Amazon. And then they also have Chewy Health and then Chewy AutoShip, all of that kicking in.
How do you do that differentiation, though? I mean, I'm a dog owner, Shweta, and I mean, I don't see a whole lot of difference between whether I buy it from Chewy or from Amazon or from some of the other online pet retailers. What can they do to separate themselves?
Well, one of the key differentiations is their customer service. It is very personalized. It's very targeted, and perhaps only focused on pet owners, versus Walmart is a behemoth and Amazon is as well. They have so many different verticals within them. So that differentiates Chewy a little bit. And then the second thing is also a little bit around the brands of food that they sell, the quality of food that they sell. Not that you cannot get that at Amazon and Walmart, but there is stickiness to the product once you are on it. And there's cross-selling opportunities that maybe is not as evident at the other platforms.
So maybe Romain doesn't love his dog as much as other people.
Are you kidding me?
All right, Shweta, thanks a lot. Shweta Khajuria, Global Internet Managing Director over at Wolfe Research. This is Bloomberg.
Welcome to our Bloomberg Radio and TV audiences, 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Alex Steele. A lot of the headlines coming fast and furious from D.C. Not only do we get Mike Johnson reelected as House Speaker, but also a lot of M&A anti-news.
Yeah, and I feel like this is going to be one of these years where Washington is really going to dominate the financial market conversation, particularly when it comes to mergers and acquisitions, and more importantly, maybe no mergers and acquisitions.
Right. And also TikTok. Let's not forget that. That's coming up as well. And so speaking of, shares of U.S. Steel are down by about 5% after President Biden blocks its sale to Nippon Steel. The two companies now issuing a joint statement saying that this was a political decision and we are left with no choice but to take all appropriate action to protect our legal rights. The U.S. Steel Union praising that move on the flip side, saying it's right for our members and our national security. Joining us now is David McCall, International President of United Steelworkers. David, good to see you. Bloomberg reported,
thank you for having me.
You bet. Bloomberg reported back in November that some rank and file members were worried that the deal could fall through and that they'll eventually lose their jobs. What do you say to them today?
Well, first of all, U.S. Steel is a profitable and viable company. The CEO of the company, when the CFIUS committee first put out some concerns and what the risks were in the merger, decided he'd start making some threats about shutting down facilities, particularly in the Mon Valley here in western Pennsylvania. Right here in this facility, and these facilities here in western Pennsylvania, we make the most high quality hot bands in the steel industry and at the cheapest price. So it's just an irresponsible threat that he makes. And of course, it scares our members. It scared a lot of political leaders as well. But as I said, U.S. Steel is a viable and ongoing concern.
So you have had no conversations today with any of your members who are worried?
I've had lots of conversations with our members today, but none of them have raised an issue about being concerned about their jobs being lost because this merger has been rejected by the president. I mean, for a year now, the CFIUS committee has reviewed what the real risks are. They've spent a lot of time with the companies, both U.S. Steel and Nippon, letting them go back and forth, trying to mitigate the issue. The fact is that Nippon's plan was to eventually shut down virgin blast furnace made steel in this country and move it to a new 3 million tons down in Arkansas in electric arc furnaces. That jeopardizes our jobs, but more importantly, it jeopardizes national security in that much of the steel that's needed for infrastructure and for critical supply chains can't be made in EAFs. It has to be made in blast furnaces.
I am curious, David, as to what you're preparing for now. Nippon Steel has made it clear that they plan to challenge it. Kind of interesting, though, that they're not necessarily going directly after the Biden administration itself, but rather really trying to sort of, I guess, maybe pick away at the contours of the CFIUS process itself, which I guess gives it credence heading into a new administration with a whole new group of people that may view this deal differently. Are you prepared for that?
Well, I'm not prepared for it because I don't think there's any appeal from what the president's decision is. When CFIUS isn't able to reach a consensus, it's up to the president. The president has rejected it. But in terms of the next administration, President Trump has said on multiple occasions that he recognizes as well that the merger would be at risk for national security issues. So he's been publicly open about that on several occasions. And as far as I know, there's nothing that's changed his mind to that.
You refer to U.S. Steel as being a viable company, and certainly on paper, I don't think anyone can dispute that. But there's a reason why we got here. You've been in this business a long time. I started my career decades ago covering the steel industry. Western Pennsylvania, central Pennsylvania is not the hotbed that it was. Same thing. You go to Illinois, all those steel plants that were there in the 60s and 70s and 80s, they're breweries and apartment buildings. What is the future of U.S. steel manufacturing? Can it just be one or two big players and that's it?
No, I don't think so. And frankly, the amount of steel that we're capable of making in this country today, we made 30 years ago. There's been a lot of technology changes. There is a lot of changes in the way we do the work, but there's also lots of changes in their equipment and in the materials and how we make steel. So we're very capable of making the steel that we need in this country. Actually, the demand is higher than our capacity. So shutting down facilities is not the way in which we can continue to grow the market.
David, Nippon Steel was going to invest anywhere between $1 and $2 billion in different areas. Have you talked to the current CEO of U.S. Steel, David Burritt, today about this?
I have not talked to David Burritt. I have spoken to the leadership from Nippon, and at some point in time, they finally started telling us what their intentions were on that capital investment, and most of it is for repair and maintenance.
Which are also important, right? Because you need to fulfill the contracts, right?
Oh, absolutely. But to just simply invest in what depreciation isn't growth in a company or isn't maintaining the new technology that it needs as the industry improves. So much of what U.S. Steel and Nippon's high-dollar public relations campaign has been over the last year is about the price that Nippon was offering on the stock. Obviously, $55 a share is much better than the 32 or 33 bucks that it was trading at the time. So it was a good deal for investors and institutional investors. Clearly a good deal for the leadership of U.S. Steel in terms of their change in control bonuses, but not good for workers and not good for the American national security.
I know there were some questions about the investment promises that Nippon Steel were making and, whether they were rock solid or maybe a little hollow. There is a question, though, about that money, and this gets to Alex's point here. Do you think we will see that type of investment in these facilities, either through U.S. Steel or maybe even the government or some other entity other than Nippon going forward?
Yes, I do. As a matter of fact, in our collective bargaining agreements, we bargain for capital investment as part of our overall strength and making sure our plants are modernized. I mean, that's where our job security comes from. And look, as far as we're concerned, stockholders deserve a fair return on their investment, and that ought to come in dividends and in growth capital on their stock. Certainly, the workers deserve the long-term security as well. We work on our jobs for decades, not for a couple of weeks at a time. Mm-hmm. So it's important that we maintain the facilities and that we keep them going. We're the most productive steelworkers in the world by any measure.
Yeah.
So we can compete anywhere, anytime.
Just one final question, and forgive me if this is a dumb question, David, but the sentiment, the sentiment that you're expressing about this deal being blocked, is that sentiment truly shared all the way down the rank and file, all the way down to the bottom?
Oh, I'm sure there are many of our members who are concerned about the irresponsible threats that some of the management have made. So I recognize that. But over the course of this last year, we've spoken to our members on multiple occasions. We've talked to the local union leadership. We've done great membership updates and meetings with them. And obviously, there's some people that's always going to be afraid of what some irresponsible threats have been made. But the vast majority of our members understand what Nippon's plan is to eventually transfer our work to electric arc furnaces and shut down our current facilities. And that's not good for our members. That's not good for national security.
All right, David, we're going to check in with you in a few weeks or months here to see how things are going. Appreciate you taking the time for us. David McCall there is the international president of the United Steelworkers. On the back of that news, that outgoing President Joe Biden has indeed blocked that $14 billion sale of U.S. steel to Japanese rival Nippon Steel. Nippon saying that it plans to appeal part of that decision, specifically involving the CFIUS ruling. Coming up here, we're going to focus in on what's been going on in the electric vehicle space. Rivian shares having a phenomenal day today, despite fourth quarter deliveries being up only 2% from a year earlier. We're going to talk about why we're seeing some optimism, though, in this space. That's coming up next on our Stock of the Hour. This is The Close on Bloomberg. All right, we want to focus in on EV stocks having a phenomenal day today. Tesla up about 8% here on the day, but shares of Rivian, that's really the star of the show. A 25% rally here on this, Friday afternoon there. I'm losing track of the days here. After the company reported fourth quarter sales and production numbers. Those numbers, they were just okay, but, investors, they're embracing it, at least for right now, as the interest that investors had was around the news about the electric vehicle maker's supply chain. Rivian reporting a previously discussed shortage of parts, no longer a shortage of parts. Jess Menton joining us right now helps to lead our equity coverage here at Bloomberg. And so this is really about kind of production, or at least the production pipeline getting back on track?
That's right. And also because investors are so focused on when this company can turn a profit and be more profitability. Its next earnings report is on February 20th. And actually, in the first half of next year, they were expected to roll out a more affordable vehicle to kind of rival some of its more, because it is a younger EV maker compared to something like Tesla. But because of what's happening with the part supplies, and that's actually improving faster than analysts had anticipated, Baird's expecting that maybe that pipeline could be moved up quicker, and maybe we could potentially see some of those models sooner than the first half of next year.
Here's my question with that, because is the affordability part, I put that in quotes, wrapping in the tax credit or not? Because that's also in flux.
So what they have, it's around $45,000 is what it is supposed to be for this model, the R2 that would be coming out. But the tax credit, so it's sort of twofold when it comes to the issues coming out potentially with the new Trump administration, because you do have the tariffs, which obviously impacts Stellantis and Volkswagen more so when you're thinking about what could potentially happen with Canada as well as Mexico. But when it comes to Rivian, because it's a younger company, those tax loopholes could affect it more so as far as when you're thinking about what's trajectory for growth. So that's going to be the big thing moving forward as far as what we could hear on that earnings call next month.
It's kind of interesting, too. I mean, there was some interesting data we got out of Ford and a couple other companies.
That's
kind of showing that despite the fact that, Tesla's numbers, at least on an annual basis, missed estimates, The idea that the other companies are still selling EVs, maybe not quite at the clip that we thought they would be, but they're still pumping them out and selling them.
And that's the question mark going forward as far as what it means for the U.S. position when it comes to EV makers. But Ford's numbers, I mean, those were record numbers for 2024, but also it was outpacing some of those EV sales for Stellantis as well as GM. So that's obviously improvements there for Ford.
It's always interesting to go around the country and see like which EVs are, you go out to California, everybody drives a Tesla. I was in Vermont over the holidays, and I feel like I saw Rivians everywhere.
I was like Matt
everywhere. I was like, where are all these Rivians coming from? You walk around New York City, maybe you see one a day at that.
I see a ton of Teslas, and I saw a Cybertruck in my neighborhood. Cybertruck coming to Park Slope.
Yeah, I see those Cybertrucks. They're a little large, aren't they?
It feels not very New York-y, I got to be honest. And what's interesting, too, though, to your point, is that EV sales jumping 12% in the fourth quarter, but you have to wonder how much, this Cox Automotive said that, but you have to wonder how much of that is let's buy now while there's still the tax credit versus waiting later when you don't really know.
And that tax credit is $7,500. And also you can lease those vehicles cheaper than buying them right now, so that could change, and that's a big thing to focus on.
That's why all Ubers have Teslas now.
Yeah.
Have you ever seen, I know, and I absolutely hate it. Have you actually seen a Lucid in the wild?
It's been a while, but we should ask Matt Miller about that.
Yeah, Lucid, remember Lucid?
I do, but I don't think I'd know the car if I sat on it, so there's
exactly.
that.
I see a Polestar. One of my neighbors has a Polestar.
Really? Polestar?
Yeah.
In the city?
Yeah, it looks fine.
All right, Jess, thanks a lot. Appreciate it. Have a nice weekend. Thanks for joining us. Jess Metten. But I don't know. It feels weird,
It's not that big. It's just a sedan.
It can get stolen. It's New York. Anyway, we're going to take you next to the close. 15 minutes away. Monster rally underway. We'll break it down. This is Bloomberg.
Welcome back to The Close. We're following breaking news crossing the Bloomberg terminal right now, including on TikTok, Alex Steele. We have now gotten confirmation that TikTok has filed a brief with the Supreme Court this Friday, urging the Supreme Court to overturn that looming ban that's supposed to take effect in just a couple of weeks' time. The U.S. Supreme Court will hear arguments on that TikTok case on January 10th. So that's a week from today. Remember, that U.S. law requires ByteDance, the main owner of TikTok, to sell it off here in the U.S. or face a ban.
Yep, I just want to point out, too, take a look at Meta stock. That was already up, but sort of holding on to those gains. Of course, if anything happens with TikTok, you got to look at the others like Instagram, YouTube, etc. Also, some breaking news for you as well. President-elect Donald Trump loses his latest bid to overturn the New York criminal conviction. He is ordered to appear for sentencing now on January 10th. This is concerning the hush money trial. The judge will not toss that verdict.
All right, so it's going to be a busy day on January 10th. And let's not, we'd be remiss in not pointing out, next week is going to be a busy day for politics as well. Remember, on Monday, Congress, by constitutional mandate, has to certify, or at least attempt to certify, the results of the recent election. January 9th is the formal memorial and day of mourning service for former President Jimmy Carter. And then now, at least two court cases we're going to be keeping an eye on January 10th, that Friday.
Yeah, one in D.C. and one here. All right, we're also about 9 minutes away from the close of market trading on this Friday. Monster rally that continues. Yes, Romain is led by tech. You got Mag 7 doing really well here. Also, the semis performing. Look at that SOX index, up by about 2.5%. But I should point out, the Russell and mid caps are still performing well today as well.
Yeah, and it's kind of interesting, too. I mean, we talk about the whole idea of that broadening out, the rotation, the cyclical rotation, if you will. That's certainly not been seen to start the year here on day two, trading day 2 of the year. But it'll be interesting to see whether we do see a little bit more steam come back into this market on a broader basis.
Yeah, because yesterday was really terrible. Like when you have a sell-off, then you have a rally, and then you fade into the close and you go nowhere fast. That is not a good technical pattern when it comes to the equity market. Yeah,
you didn't see the Russell up there, but it is doing a decent job today, keeping pace up about 1.6%. So actually in line with what we're seeing on the NASDAQ composite and actually outperforming the S&P 500, at least for today. About 7.5 minutes until we get to those closing bells. Jonathan Krinsky joins us right now, Chief Market Technician at BTIG. And I am curious about this idea of momentum and what people are chasing. And I know we've kind of framed this as everyone's just chasing after big tech. That's the trade here. But is there any sense here that we're seeing more momentum actually broaden out a little bit more?
Well, unfortunately, we're not really. And, December was in some ways some of the worst breadth metrics we've seen, at least in quite some time. And the issue is the dollar and interest rates continue to put upward pressure. They continue to move upward, and that's putting downward pressure on the broadening trade. If you think about when the Fed began to cut rates in September, that was supposed to be key for the broadening trade, and really breadth is not actually, it's actually gone the other way, and December was kind of a culmination of kind of that weak breadth. So it's possible that December was a bit of capitulation, and we could see, the bulls are hoping we'll see some broadening, but again, until and unless the dollar and interest rates can at least stop their ascent and likely reverse those trends, it's going to be difficult for areas like small caps to really have a sustained outperformance.
Well, I am curious about that, and we kind of started the show talking about that interplay, particularly between yields and stocks. You throw in breadth, you throw in, obviously, whatever is going to be happening in Washington over the next few months. There is a question here, Jonathan, given the outsized gains that we've seen in the market over the past 2 years, whether maybe it is just time for a real old-fashioned correction.
Yeah, I mean, that's the alternative, right? We talked about this in December where the proverbial rubber band was getting stretched to the point where you're either going to need to see breadth catch up to the leadership names, the momentum names, Mag 7, or you're going to see those leadership names fall down and catch down to breadth. And, we're seeing it in Apple. Apple had a stretch in December of 5 straight weekly gains of 2% or more. That historically is actually a bearish sign for Apple over the next month or two. So we're seeing Apple come under pressure, but the rest of the Mag 7 names really haven't. So I think the next week or two will be telling, and then obviously we get into earnings. But again, the longer you see upward pressure on yields and rate and the dollar, I know it hasn't been a headwind to mega cap tech to this point, but I think any further breakout to the upside in those cross-asset moves will likely hit those leadership names.
Jonathan, let's talk about other assets real quick because yields continue to grind higher. The dollar is on a tear. I appreciate the day is a little bit mixed, but we're talking parity now for euro dollar in a very material way here. We're at 1.02. How much more upside can yields on the dollar have right now on a technical level?
Yeah, I mean, look, the dollar is the highest since the fall of 22. The interesting part is it actually just broke out of a multi-year base a couple weeks ago, and so from a purely technical perspective, there's still some decent upside on the U.S. dollar. Interest rates, depending on what you look at, are a bit more mixed. 30-year real rates are actually are at new cycle highs, the highest since the fall of 22. So there's definitely a bit more room, but it's really we're focused on the trend. And as always, when you get these cross-asset correlations, it's more the velocity of the move than the actual level. Again, because if you think about where 10-year rates were, we're at the same level we were in the fall of 22, and the S&P was had a 4 handle on it. So it's not necessarily the absolute level, it's that move. And if you were to get a significant and quick move to the upside in dollar yields from this level, I think that would be problematic. If they continue to just kind of churn around, you're going to see more of the same, where it's a little bit maybe weak breath under the hood, but the overall market is okay.
Okay, good distinction. Quickly, Jonathan, we saw S&P almost want to kiss that 100-day moving average yesterday. Obviously, it's rebounding today. What are the chances that we retest that, and what happens after?
Yeah, so we don't necessarily look at the 100-day, but we've been eyeing. There's a gap from the U.S. elections, which S&P futures actually did trade down to that level. The equivalent on S&P 500 cash would be about 57.83. And if you were to fill that and not see any material bounce, look, we did not test the 200-day moving average on the S&P at all last year. So the clock probably is ticking for that. Even if you were to test that in a straight line, that would still only be about 9% off the highs. So, as we get into January, I don't think that's out of the question. Again, we're not necessarily calling for that, but it just goes to show, how far things have come, and that a 9% correction would feel pretty bad, but it's really not that bad.
Yeah, last meaningful test of that 200-day average, believe it or not, all the way back in October of 2023. Got to leave it there, Jonathan. Jonathan Krinsky, Chief Market Technician over at BTIG, helping us count you down to the closing bell. Stocks moving near session highs. The NASDAQ composite up 1.7%. A full breakdown of all of today's market action starts right now. And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here, alongside Alex Steele. We're taking you to that closing bell with a global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth, as we welcome our audiences across all of our Bloomberg properties here on this Friday afternoon. Carol, a decidedly different day than what we saw yesterday. All the major indices up about 1% or so on the day.
So well said. I mean, 5 down days that we've had before this of the S&P 500, the NASDAQ 100, a different tone, some broad-based buying here on this Friday. So we'll see whether or not it holds as we get into a new week next week.
How's this for a superlative? Best day.
What?
Tim loves saying
2025.
Oh.
Just indulge him.
How long? Excuse me, Dad. How long do you plan to make that joke?
Well, I just made it on
I'm
radio.
just sad he got there before me, man.
I was doing like a test run on Carol earlier. She laughed.
Did it with our market guest.
Yeah. So.
And how'd that go over?
And she loved it.
She chuckled.
Yeah.
You know, we should mention though that stocks reached session highs after Johnson was reelected Speaker of the House. It's a reminder of how personnel makes policy and how politics is really going to be a driving force in the markets this year.
Okay, and just to point out, thank you, Finley. Romaine was making that exact same joke yesterday. Okay, that was the worst day so far this year.
I learned from the best.
How dare you call me out like that?
I'm just saying. Let's blame Finley on that one.
I am curious, though, too. I mean, in all seriousness, we talk about this idea of whether the price action that we're seeing today, just like what we saw yesterday, is that really reflective of what we're really going to see transpire over the next few weeks or even for the rest of the year? How much can we read into this? Think about that, Tim, and see if you can come up with a joke for that.
I'm thinking.
Clapping and cheering here, and a good reason to clap and cheer here, with the NASDAQ Composite leading the charge on the day with a 1.8% gain. The NASDAQ 100 up about 1.7% here as the market tries to get its mojo back after several days of declines. The S&P 500 also higher by roughly about 74 points, or about 1.3%. It's still going to close below that 6,000 level, 59.42 and change. The Dow up about 300 points, or 0.8%, and the Russell 2000 trying to keep pace here, a 1.6% gain here on the day, up about 37 points.
Wow, that's an interesting trade. All right, guys, and if you look at the S&P 500, most names in the index actually gaining some ground today. 394 names, Scarlett, to the upside, 109 to the downside.
All right, let's take a look at the IMAP, which shows the sector performances. Spinach pie, pesto pie, whatever you like. It's all green all around. Consumer discretionary leading the way, up 2.4%, really powered by Tesla, which ended its own 5-day slide. Infotech gaining 1.6%. REITs up by better than 1.25%. The worst performers, or I should say the laggard here, is materials. Little change on the day, and the only sector to decline in 2024, losing 1.8% in the year.
All right, as you said, a lot of green, so a lot of choices for me. Rivian Automotive up 24%, guys, finishing pretty much at its highs of the session. The company coming out, announcing some production numbers for the fourth quarter that beat the average analyst estimate. I should point out that this stock, though, heavily shorted, about 19%. So any good news, you might see a bunch of short covering, but nonetheless, definitely a standout in today's trade. Rivian. Nomura, this is something that Tim talked about, Nomura Therapeutics. This biotech, very small cap name, rallying nearly 26% at its highs today, following an 81% plunge in the Thursday trade yesterday. The company yesterday saying its depression drug failed in a late stage study. Mizuho coming out today and saying the shares were oversold. So you saw some investors coming back in, and the stock finishing the day with about a gain of about 10%. One more for you. It's a small cap application software company. I kind of went to interesting places that all have kind of high short positions right now. Cerent is, as I said, a application software company. Shares soaring as much as 150% in today's session, finishing the day with a gain of 143%. The voice AI company announced an expanded collaboration with NVIDIA to advance the capabilities of its, large language model family of applications. And so nonetheless, we saw investors moving into this one in a big way. Tim?
I also just want to point out, too, Fannie and Freddie. Remember them?
Oh, yes.
Up more than 20% here, maybe potentially a release from government.
Maybe, right?
All right, those are the gainers. I got the decliners. Actually kind of easy for me to find them today. I know you guys are familiar with this one on the day. U.S. Steel ticker X down 6.53%. You just interviewed United Steelworkers of America International President David McCall. We tuned in for that. Shares ended up falling today as a result of President Biden blocking that $14.1 billion sale of the company to Nippon Steel. It killed that high-profile deal. Shares fell earlier in the session as much as 8.4%. And then shares of alcohol producing companies, beer makers, wine companies, liquor companies falling today. This after U.S. Surgeon General Vivek Murthy said that alcoholic drinks like beer and wine should carry warnings of their links to cancer. Molson Coors down 3.6%. Alcohol does cause about 100,000 cases of cancer and 20,000 related deaths each year in the U.S., according to Dr. Murthy, far more than the 13,500 alcohol-associated annual traffic fatalities. We also saw Boston Beer fall, Constellation Brands fall, and ADRs of Diageo down as well. Finally, Carvana down 11.2%, down for a second day in a row after it was accused by prominent short seller Hindenburg Research of impropriety in that report that alleged that the company's subprime loan portfolio carries substantial risk and its growth is unsustainable. Carvana did say the allegations are nothing new and said, quote, "The arguments in that report are intentionally misleading and inaccurate and have already been made numerous times by other short sellers seeking to benefit from a decline in our stock price."
All right, guys, I'm taking a look at the bond market. It was a really whippy day. It was kind of interesting. And we ended with yields higher pretty much across the curve, up by about 4 basis points. Now, just to put in perspective, 10-year is where we were on Monday. So to your point, like it's Jonathan Krinsky of BTIG was saying, it's the velocity of the move, not necessarily the absolute level of the bond market. But, guys, I got to point out, $119 billion worth of supply coming on next week, the 3, the 10s, and the 30s. So watch that as everyone kind of returns to office.
I might buy some.
Really?
Yeah.
Buy some bonds?
Sure, why not?
The bonds?
Yeah, the bonds.
Okay.
I heard it's all the rate.
Where on the curve now?
On the shortest end of the curve, Alex Steele.
1 month.
1 month.
2 seconds, baby. 5 minutes. All right, let's get to some of the stories that definitely caught our radar. This is kind of a little bit of a somber tone. This is coming from the Wall Street Journal, guys. I feel like we've been talking or focusing a lot about kind of like the sin stock area or whatever, things that aren't good for us. And this one kind of falls into it. Researchers identifying a focal point for the forces they suspect of driving up cancer cases in young people. And they talk about the gut. There's been so much more focus right on the gut, the health of the gut and the implications of it. But rates of gastrointestinal cancers among people under 5 are increasing across the globe.
Yeah, specifically colorectal cancer. And it's alarming doctors around the world. And the question is, what's causing it? What changes need to be made in order to prevent it from happening? And then my question is, how does the screening process change? If this is happening in younger folks, does it end up changing in coming years, government guidelines for when people are screened for these types of cancers?
Well, yeah, and also what I thought was interesting about that is sort of their range of possible explanations, right? Mm-hmm. We'll talk about this in a second, too, but potential alcohol, right? You have the microplastics, many different things that we can kind of point to and understand, but no one knows a direct correlation, so it's hard to then wind up preventing that.
I mean, I know a GI doctor who deals with this stuff every day, and she and her family have stopped eating certain processed meats as a result of the rise in this type of cancer in young people. So the big question is, what is that link? And what are the changes we can make in our diets in order to prevent that stuff from happening?
Well, it dovetails really nicely with the big story that we've been covering all day today, one of the most read stories on the terminal. And Tim, you mentioned this earlier about the Surgeon General calling for these cancer warnings on alcohol. What does this do for people going to bars and pubs and all that? I mean, I guess we can order the non-alcoholic drinks.
There's a non-alcoholic bar opening in my neighborhood.
Really, in Park Slope?
It's so Park Slopey, but that's
not. That is such a Brooklyn thing.
It is such a Brooklyn Park Slopey kind of thing. But you know what's interesting about this?
Isn't it just called like a bodega?
No, it's a whole bar. It's cute. It's fun. You can hang out. There's food. It's super cute. And then also
they make mocktails.
They make mocktails.
Okay, got it.
And they probably have, I don't know, it's not open yet, but they have like non-alcoholic beers and wines, I'm guessing. So maybe that's a thing. But here's my question, guys. What was the lag time between Surgeon General warnings on like women who are pregnant don't drink alcohol to like it actually hurting sales?
It's more in the zeitgeist. I don't know.
I just totally crushed
that
conversation.
No. It's a good question, but I think it's more in the zeitgeist. It depends. If you believe the Europeans, there was no lag time.
Well, I mean, in all seriousness, there's a question too. I mean, when I saw this, two things jumped out at me. Was A, that I feel like a lot of outgoing people are pushing through a lot of things that could, of course, be overturned by the next Surgeon General. But also the question, and this gets to your idea, Alex, is like, I hate to say it, but how many people are going to pay attention to those labels? And how graphic are the labels going to be? Are they going to be like the European-style labels that you see on cigarettes?
You make an interesting point.
Or is it just going to be a little, a few words at the bottom that everyone will ignore?
We spoke to our Bloomberg Intelligence analyst earlier in our program out in London who said that in South Korea it actually had the opposite effect
People went out and did a bunch of buying, right?
And people went out and bought more alcohol. He said, don't look to that for that happening everywhere.
Wait, they put warning labels and people went in and bought more alcohol.
Yeah,
what,
he said
like defiance of what?
Labels. But,
Okay.
but I think we're also talking like generations down, right? Like it might not affect us today, but generations down, the same way it was for cigarettes and alcohol with pregnant women, that might be the change.
Listen, I look at our studio, right? You don't drink. I drink occasionally. I mean, and it's just like, it's interesting. I think you see a trend more generally, right? Of people maybe pulling back or different generations.
We
have going to that mocktail
wait,
bar.
first, did Carol say she drinks occasionally? Don't you guys have like a cocktail guest like every week on that show?
We do have a guest today.
Today it's
Libby Wines.
Of course. See? I'm not just making this up.
Non-alcohol.
Oh, it's non-alcohol. Okay, all right. There you go.
It's like you knew this story was
Chris,
across.
I might bring my own wine bottle into the studio. I'm just going to put it out there. All right,
I
guys.
did that once. I ordered a mocktail at a restaurant, and I was like, I think this would be a lot better with just a little rye whiskey in it. And so I ordered a shot and put it in there. It was great. It was delicious. Yes, I did. And I told the waiter, I said, this would be great on the menu. You're welcome.
All right, this does not surprise me. All right, have a good and safe weekend. Alcohol or no alcohol, make your choice.
There'll be alcohol.
All right, our cross-platform, radio, TV, YouTube, Bloomberg Originals. Be well, guys. We'll see you again on Monday, same time, same place.
All right, and as we say goodbye to Carol and Tim, we say goodbye, of course, to Alex Steele. Scarlet Fu sticking around here for the next hour. A lot more coverage coming up, including a deeper dive into the retail sector. Our first big check on the retail space since the holiday shopping season. We're going to talk to the guru of that space, Dana Telsey. She's joining us after the break, right here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A phenomenal way to end the week, though we should point out the gains that we saw today in U.S. financial markets. Not enough to rescue the markets on a weekly basis, still down on a week-to-date basis, but the 1.3%, I think a lot of folks will take it as the S&P tries to inch its way back up to that 6,000 level. Got a lot of help today, particularly out of the Mag 7, out of the semiconductor stocks, and as well as around a lot of the EV stocks. Tesla having a phenomenal day, up about 8%. You had a lot of the EV stocks, including Rivian, also posting pretty outsized gains here. Even Bitcoin getting its mojo back. There were a few down spots in the market today, and you're going to find that in the metal space, particularly when it comes to names like U.S. Steel, Alcoa. Maybe this is tied, Scarlet Fu, to what we learned a little bit earlier. The Biden administration formally blocking that purchase of U.S. Steel by Japanese rival Nippon Steel.
Yeah, the $14 billion purchase is a no-go, according to President Biden. U.S. Steel losing 6.5% after losing as much as 8.4% in regular trading. Now, both companies say they plan to challenge this order, falling just short of actually saying that they will sue the U.S. government. I'm also looking at alcohol companies. Constellation Brands, Boston Beer, Anheuser-Busch, Molson Coors, all declining after the U.S. Surgeon General, the outgoing U.S. Surgeon General, called for cancer warnings to be placed on beer and wine, citing evidence that links cancer to drinking. You can see declines, not huge ones, but modest ones here in Constellation Brands, but it has created a beneficiary of sorts. And we're talking about the ETF that tracks marijuana companies or marijuana-related companies. YOLO is the ticker for AdvisorShares Pure Cannabis ETF. That stock or that ETF closing up 2% on the day. But our top story this hour really centers on politics. Mike Johnson, re-elected Speaker of the House, paving the way for incoming President Donald Trump to move forward with his legislative priorities. We're talking tax cuts to crack down on illegal immigrants. Johnson overcame initial resistance from within his own party to secure the necessary votes. Later in the program, we're going to be talking about what's next for Trump's Republican Party in the weeks ahead.
All right. Well, before we get to that, let's get another check on the markets here because this is time, one of our favorite times of the week here, Factor Friday with Chris Cain over at Bloomberg Intelligence. And Chris, I was going through the list of factors. I was looking at momentum. I was looking at value. I was looking at all these things. You don't want to start with any of those. No. You want to start with something called EPS revisions, which I have to say I've not really paid close attention to. Explain it to us.
Yeah, absolutely. So, EPS revisions, like you kind of mentioned, I wouldn't call it a standard factor, right? It's not one of those factors that have a ton of academic support, a ton of practitioner, results. Those are things like value, momentum, et cetera, right? Mm-hmm. But EPS revisions, we think it's very important for investors to keep in mind. It certainly worked very well, both over the long term and last year. So how the EPS revision factor is formed is basically how have the forward quarter EPS expectations changed over the last 3 months from Wall Street analysts. Okay. So as Wall Street analysts, thinking the earnings are going to increase and revising up or revising down. If you take the Russell 1000, breaking up into quintiles, the top 20% with the highest EPS revisions beat the lowest 20% by about 14% this year. So it's certainly been a factor that's been driving returns.
What about the long-term performance of this factor, of the EPS revision factor? How's it performed, say, over the last 15 years?
Yeah, that's kind of what really brought us to this factor in the first place, is that it's really performed so well long-term and very consistently. So again, when you break the index into quintiles by the EPS revisions, I should say we rebalance this portfolio every month. When you look at those quintiles through time, since 2010, that high EPS revision quintile, the Russell 1000, is up about 800%. The low EPS revision is up only about 250%. So it's certainly been, a pretty large outperformance over time.
So with the high EPS revision portfolio, what sectors are we talking about? Is that just like the Mag 7?
No, actually. I think you'd be surprised. So, when we look at sectors in these factor portfolios, we think the fair way to do it is what percentage of the sector makes a quintile, right? Because there's different amounts of stocks per sector. The highest percentage that makes the high EPS revision quintile is actually utilities. A lot of that
was a big outperformer last year.
Exactly, right? So, but people just think of that as like sleepy, kind of a boring sector. But people are a little bit surprised by that. And then things like communications, tech, kind of round it out. And then the
real estate's on there, yeah.
Real estate, yep. And then the sector that really dominates the low EPS revisions, and this is rather dramatic, is energy. Energy puts about 70% of its Russell 1000 members in the lowest quintile based on EPS revisions of the index. Wow.
So that sounds like the boring sector these days then.
Yeah.
All right. Cain of Bloomberg Intelligence with our Factor Friday. Thank you so much. Let's turn now to the world of retail. If you look at consumer discretionary stocks, they climbed about 30% last year. And our next guest expects a continued recovery in this discretionary spending, assuming no additional tariffs are implemented. However, she does go on to say that the likelihood is quite high that new tariffs will be implemented. I'm pleased to welcome back Dana Telsey, founder and CEO at Telsey Advisory Group, who joins us now. Dana, did you see evidence of retailers or brands convincing consumers that perhaps tariffs were coming and it was time to buy a lot of their big purchases now before those tariffs raise prices?
Haven't seen that, but what we did see is more promotions this holiday season than last year. It was definitely a tick up. The holiday season started earlier when Best Buy advertises holiday in September.
Yeah.
The compressed season with 5 fewer days between Thanksgiving and Christmas makes a real difference and created a sense of urgency, which has led so far to Visa and MasterCard giving better than expectation numbers on the season. 4.8% at Visa, 3.8% at MasterCard, all bigger than the 3 to 3.5% gains that were originally expected.
I'm sorry, can I just follow up on the promotions? Because one thing I noticed, at least for the companies that I buy from, I felt there were a lot of stealth promotions. Like if you just went to the website, you wouldn't see the discounts. Even some of the emails they sent really didn't make mention of it. But when you kind of dove deeper, there was always like some little Easter egg where if you managed to unhatch it, you would get, that extra 20% on top
of
whatever discount. Yeah, it was. And I thought that was kind of creative because I guess you have to make a little more effort to get the discount.
Yep. Keep in mind, loyalty members, they got an extra discount.
Yeah.
It was 20 to 30%, not like it was years ago when you had 40 to 60% off. So yes, it is more promotional than last year, but certainly managed and well within the expectations of what retailers are looking for in terms of their margins.
But that gets to the idea that they really do want people to go into the stores, because once you get them into the stores, they may spend more. And we were talking earlier about how gift cards are always a popular gift, if not a very creative one, and retailers love it because when people actually go and redeem the gift cards, that's where the spending happens.
Exactly. This is the month. January is the month when everyone redeems their gift cards, typically when they go in to redeem them, and that's when it's counted as a sale in retailers' books. But typically they can spend 20% more. So that uptick that you're going to get, it's a benefit to traffic and it's a benefit to sales. And let's not forget, February's coming, Valentine's Day is coming, that's the next holiday.
Chocolate is pricey now.
It is pricey, you're exactly right. But people are still going to buy chocolate for Valentine's Day.
They are. I am curious, and this is going to get a little bit more into the economic conditions, because we're heading into a year where there is some uncertainty about the health of the consumer and their ability to spend. And I want to specifically start off with this idea as to whether people are trading down, because there's been so much anecdotal evidence that high-income earners are now trading down to slightly, to like a Walmart, and folks that would normally shop at Walmart are looking for something even cheaper. Are you seeing that play out?
100%.
Yeah.
We've seen that in many different areas. Look where Doug McMillon, the CEO of Walmart, talked about where his biggest growth is coming from some of their band of higher income consumers. Look at aspirational consumers. They're no longer spending on some of the luxury goods that they spent in the past. It's trickled down. The benefit of the traffic of off-pricers, where they have very good brands and off-pricers, but it's at a value price, they're getting the traffic and they're getting the sales. So we've seen the conversion of some higher income consumers to essentials and to value pricing.
We're just about, a couple of weeks or so away from the inauguration of President Trump, who's promised to impose additional tariffs as well as some new tariffs. There's a lot of concern this could have an outsized effect on the retail industry. Are they prepared for this? Are they already preparing for this?
I think they've been preparing for it. The diversification of sourcing of goods away from China has been definitely top of mind. The footwear retailers have the most exposure to China. Others, like the Abercrombies and some apparel retailers, have already gotten their exposure to China down to single digits from what had been double digits. It's a concern because we know what the consumer doesn't like is price increases. So it only makes value matter, and that's why we lean defensive in retailers that offer value, like the discounters and like the off-pricers, or strong brands offering newness and innovation. Hello, Birkenstock, where Germany and Portugal are where they make their goods. Or you take a look at others, you look at Abercrombie when there's newness and innovation too.
How many pairs of Birkenstock
Like 30
do you own?
pairs at this point of Birkenstocks.
Excellent.
Yes.
You're past the average of 3.6 for the average American.
3.6. Oh, I blew past that long ago.
Buy those closed-toe shoes too.
Yes, I do that as well.
Good.
So tariffs are a big question mark here. We don't know when they're going to come or in what form. But another big question mark is the possibility of strikes at the ports once again. We know that talks are supposed to resume next week. What does inventory look like for retailers? I mean, we knew the last time around they kind of got ahead of it, but are they ready for another potential strike?
A lot of them have been moving where they bring in their goods from, some of them using air. I think they're ready because one of our themes for 2025 is, while it's about social, service, supply chain, it's about surprise. We know this strike has been on the docket for a while, and so they're prepared for it. Luckily, it would be happening after Christmas, not before Christmas. Goods are in, but retailers are having to pay more to circumvent where those goods arrive.
Dana, always a great conversation.
Thank you.
Looking forward to see how 2025 plays out in the retail space. Dana Telsey, the founder and CEO at Telsey Advisory Group. Do you know what I became an owner of for the first time?
Birkenstocks.
No, a pair of Uggs. My
Really?
son gifted me a pair of these. He said they're all the rage with
Like
the kids.
slippers?
Yeah, they're like, but you can wear them outside to like walk the dog.
Oh my
and
God!
stuff like
Please
that.
take a picture and post on social media.
I don't know if I'm going to take a picture and post it on social media.
Remain in Uggs.
I love them.
All right, coming up, we've got the top three where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. What color? Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Ken Keyes. He's a longtime Republican tax lobbyist, and he is Donald Trump's pick for Assistant Secretary for Tax Policy. That means he'll be the guy working on extending the 2017 tax cuts.
Yeah, it'll be kind of interesting. Obviously, he's had a long relationship, not only with Trump, but obviously with the Republican Party.
Yep.
He's actually well respected in Washington, certainly cut from a slightly different cloth maybe than some of the other appointees. So it'll be interesting to see what he can shepherd. I'm actually keeping my eye on somebody who's decidedly different than Ken Keyes, and that is Jason Kelsey, the former Philadelphia Eagles center, has a new late night show, debuts on ESPN and ESPN Plus tonight at the ripe old time of 1 a.m. Eastern time. Scarlet Fu, you staying up for this?
I'm not going to stay up for it, but other people are, because it's going to be in front of a live studio audience as well. And it's going to run through the end of the regular season and the playoffs, so 5 episodes. There's going to be guests like Charles Barkley and the rapper Lil Dicky.
Okay, you lost me a little, Dickie. I'll tune in for Barkley, though. Who are you watching?
All right, third on the docket is Bad Bunny, the singer dropping a new short film that's linked to his new studio album that is coming out on Sunday. This 13-minute film arrives in the middle of a pretty elaborate album rollout. He's got a big year coming up because Bad Bunny will be in Happy Gilmore 2. Which, is a crowd pleaser.
Yeah, you're still on the little stuff. Good for him. I think it's interesting, too, how these artists take this approach now to these releases. Like, it's not enough really just to kind of put the album out. It really has to be coordinated, and obviously a gigantic international star like him, it's almost like Beyonce or Taylor Swift. Like, you're not going to do it half speed.
Right. No. You got to go all in, and it's drip release, a staggered release.
Did I ever tell you the time I met Bad Bunny?
You did?
I was walking home from Bloomberg World headquarters right up Park Avenue. And
on the Upper East Side.
And I saw this guy. Yes, this was a few years ago. It must have been right at the start of the pandemic, just wearing this crazy like kaleidoscope suit. He
stood out.
Yeah, and I stood out, and then I was like, oh, this Bad Bunny. He was very nice.
You talked to him and everything?
I did. I talked to
him. Said Mr. Bunny?
He was a very nice guy. I did not call him Mr. Bunny, but we did have a nice conversation. All right, coming up here, a lot more to talk about. A refocus on politics as Mike Johnson finally gets it done. We're going to discuss what's in store for the re-elected House Speaker, particularly on Donald Trump and Elon Musk perched on his shoulder. This is The Close.
That sounds fun.
Inflation, we have a big agenda. We have a lot to do, and we can do it in a bipartisan fashion. We can fight high inflation, and we must. We'll give relief to Americans, and we'll extend the Trump tax cuts.
Mike Johnson, who, of course, was the Speaker of the House in the last Congress, will be the Speaker of the House for the new Congress, just sworn in today. And as you just heard him say, they've got a lot to do, and that might be the understatement of the day. Bloomberg Balance of Power co-host Kailey Leinz joins us right now, who's been keeping tabs on everything that's going on in Washington. A speaker's vote that turned out to be a little less contentious than we thought it would be, at least publicly. But I do want to push ahead, Kailey, to next week. You've got to certify the Electoral College vote from the most recent election on Monday. You've got, of course, the remembrances and services for Jimmy Carter all week long, culminating in a big national day of mourning on Thursday. And then you got a couple big court cases on Friday involving the president-elect and, of course, TikTok, two separate cases, if you will. Where do you start, Kailey?
Well, this all just speaks to a stacked January calendar, Romaine, that really provided additional leverage on those who were supportive of Mike Johnson to exercise in the vote today to say, hey, the House needs to be able to get down to business. A speaker needs to be elected and quickly, in part because the constitutional duty exists to certify the electoral victory of Donald Trump on Monday, January 6th. It's a deadline that didn't exist when Kevin McCarthy was attempting to be speaker through 15 rounds of voting at the beginning of the 118th Congress. So, yes, this went smoother today, but it does really signal that there are going to be challenges ahead for Mike Johnson. He was able to get the gavel, but he is still going to be dealing with an incredibly narrow majority. And so it's going to be hard for him to get actual pieces of legislation across the finish line after Donald Trump has taken the oath of office on January 20th. But as you say, Romaine, even before we can get to January 20th and everything legislatively that's going to come before then, it's going to be a very busy week, or after then, rather, a busy week next week. The state funeral for Jimmy Carter is on January 9th. He'll be lying in state in the Capitol beginning on Tuesday, the 7th. And the 10th is stacking up to be a really big legal day. Not only will the Supreme Court be hearing arguments as to whether or not the TikTok ban should be prevented from going into place on January 19th, but we've just learned from New York that Donald Trump will be sentenced in the hush money case in which he was convicted of 34 felony counts of falsifying business records. Trump and his legal team have been pursuing many avenues to get this case dismissed entirely based on a previous Supreme Court decision around presidential immunity. But the judge, Juan Merchan, has shot that down, not vacating that verdict, but signaling that he's not going to be sentencing Trump to any kind of prison time here, suggesting a conditional discharge is likely what he will go with. So as long as Trump isn't arrested for any other crime, he essentially will get off on this one.
Okay, got it. Thank you for clarifying that. So, Kailey, of course, we also, as you mentioned, have that decision on TikTok. And there's been a lot of question marks on how Donald Trump feels about this, because when he was in office, of course, he opposed TikTok and talked about forcing ByteDance to sell that business. And now it seems he's changed his tune. Does it matter that he's changed his mind on this?
Well, he has made it clear he would like the Supreme Court to rule in favor of TikTok in this regard. He has suggested he is more supportive of TikTok now, having experienced a greater share of the youth vote in the election in November. And he does think TikTok ultimately played a role in providing more young people coming over to his camp. So it's just a question of whether or not the justices, frankly, care that much about what the president-elect and ultimately president is going to think. They could be sympathetic to the argument that Trump and TikTok have been making, which is that you should at least hold off until after the new president and new Congress comes into power to see if anything politically would change in regard to this ban rather than having it take effect on January 19th. But it'll really come down to the justices in these arguments, what kind of questions they ask around the First Amendment specifically, because that is really what the crux of this issue is, whether or not TikTok and TikTok creators specifically are having their First Amendment rights violated by the legislation that was passed on a bipartisan basis and signed into law by President Biden.
All right. Kailey Leinz, Bloomberg Balance of Power co-host. Thank you so much. And of course, Kailey and Joe will be back at the top of the next hour with Balance of Power. We're going to stick with politics right now and bring in Kim Wallace. Kim is head of Washington policy research at 22V Research. And Kim, I want to go back to Mike Johnson's relatively smooth re-election as Speaker of the House. Just one round of voting, although it was confusing whether it was one round or two rounds, given that they had to pause everything and he had to confer with the two Republicans who had voted against him initially. Does that smooth re-election make you more or less confident in Johnson's ability to manage his conference, which is still fairly divisive, and turn out legislative victories for incoming President Trump?
Well, Scarlett, what it makes me feel is probably a little bit less important than what it makes the speaker feel. I'm sure he's relieved to have the vote behind him, but only he knows how difficult in private it was to get to this point. And process matters, of course, whether it was one vote or two votes, but the results matter more. He's Speaker of the House for the 119th Congress, and now he's able to address his conference and try to move an agenda that is, as Kailey was pointing out, front-loaded in January with, you would say, legislative optics, but early on, February through the end of December this year, will be a lot of legislative lifting.
Yeah, it's an ambitious agenda, and I wonder to what extent rising interest rates plays a role here. The 10-year yield, I look at it, it's been stuck around 4.55%. If it goes up to 5% or even maybe 6%, as T. Rowe Price has warned, are there parts of that agenda that are vulnerable to getting scrapped?
Oh, certainly vulnerable. Whether or not they are eventually scrapped, we'll wait and see. Time will tell. But this century, times when the deficit has grown or countercyclical spending had to kick in, the bond market reacted. The bond market is, you wouldn't say on tenterhooks, but certainly if you measure by yield, they're a little more nervous. It's a mixture of outlook for growth, which has been very constructive, again today confirmed by PMI manufacturing, along with the fears of profligate fiscal policy. I don't think anyone can weight how much is pushing on 10-year note yield, but certainly it's a factor.
I am curious, though. We talk about the majority, and assuming that Trump's nominees, some of those coming out of Congress, do actually get confirmed. You're talking about 219 in the House, a one-vote majority. And it was kind of interesting to see Mike Johnson make a nod a couple times during his speech today to the minority leader, Hakeem Jeffries, the Democrats, who he's going to have to work with and convince to work with if he wants to get some of the things that he wants passed. Are the Democrats going to give him that kind of grace?
Well, again, it depends on what's on the table and their incentives. It's hard to prejudge this stuff, Romaine, but, last Congress gives us a taste of what we might expect in this Congress. Of course, the difference is a different person in the White House, someone who leads the party that's in the majority in Congress. That should help Johnson. Of course, two of the last three Fridays, Speaker Johnson had a very difficult time delivering on agenda items that President-elect Trump wanted, and it took to the last minute in some cases to get those done. That's as much a function of close margins as anything else. but those margins aren't going away. Even after April, after a few special elections, Speaker Johnson will have 2 or 3 votes to lose on every vote. What that means more than likely from a practical standpoint is more time. Everything's going to take longer to accomplish.
There's a lot that we don't know about what happened behind closed doors, but based on the reporting we have so far here at Bloomberg, we do know that this might not have actually happened if Trump himself had not intervened, at least with a couple of particular key congressmen. And I am curious, going forward, as we get into the budget battles and some of these other contentious votes that we're going to have over the course of the year, are we going to see a repeat of this, where the only way it gets done if Trump himself basically puts himself in the middle of it and tells everybody this is how it's going to be?
Well, as you said, it's hard to know the future, but I can't imagine that process changes. If you're one of the 3, 4, or 5 members on any legislation who's not gotten their way, you're going to wait for a call from who will then be President Trump. And this will minimize to some degree Speaker Johnson and his team's ability to close deals. But, they have a designated hitter in the White House who's got a pretty good record with his party. My guess is what we saw during the continuing resolution debate and what we saw today is likely to be the process. And let's face it, it's a process that President-elect Trump is known to favor, that is, being the closer and being the one who determines outcomes. So, yes, I would think we'll see a lot more of this as we go, particularly on tax policy.
All right, 219 Republicans, about 215 Democrats, a couple independents in there here. Slimmest margin for a party in the House right now, going back to 1930. Kim Wallace, head of Washington policy research over at 22V Research. And Scarlett, I think that really is going to be the key here. I mean, there has to be compromise.
Yeah.
If they want to get anything done.
Although the Republicans who opposed Johnson's reelection as Speaker were not happy with the compromises that Johnson struck with Democrats to get the spending bill passed.
But you think about so many of the policy proposals that Trump campaigned on. These aren't simple majority votes to get those things done in Congress. You need 2/3 for some of that stuff. And even the stuff that just needs 50-50, again, you got to convince every Republican to stay in line, despite the fact
or convert some Democrats.
Yeah.
Good luck with that. Yeah. All right, let's take a look at how markets closed on the day, because day 2 of 2025, the day trading day 2, means that the S&P 500 is now green for the year, up 1% for the year after this 1.25% increase. There was no Santa Claus rally because the S&P 500 fell almost 3% during its 5-day slide, but we got it kind of a week later. And the Mag 7, the big tech stocks, really led the way here. 10-year yield steadily rising during the session, now right up against that 4.6% level.
Yeah, and that's going to be a huge part of the story here. Kind of what direction do those yields go? A lot of people warning about 5%. You see the dollar, a rare down day for the dollar index.
Taking a breather.
Yeah, all right. Meanwhile, though, Bitcoin was up for a fourth straight day here as it starts the new year. And when we return, birthday wishes for Bitcoin, which was first mined 16 years ago today, Scarlett. Where were you? And a question before we go to break. What was the first ever commercial transaction paid with Bitcoin?
I'm sure it was on the dark web somewhere.
This is Bloomberg. All right, let's take a quick look back in history. This day, January 3rd, 2009, Satoshi Nakamoto mined the very first Bitcoin. Now, that so-called Genesis block of just 50 coins came 6 days before the actual release of Bitcoin software and the cryptocurrency network. Now, as momentous as we now know this occasion to be with 16 years of hindsight, at the time, it went largely unnoticed outside a tiny cabal of fintech enthusiasts. In fact, it was largely an inauspicious start for what would become one of the most audacious and successful financial experiments in modern history. But it did take time. After its January 2009 release, the first real market price of Bitcoin didn't even materialize until 9 months later in October, where 5,050 coins were sold for just $5.02 in total, giving each Bitcoin a rate of 0.00099 cents, or about 1/20th of 1 penny, a pittance. Now, the earliest headlines in the mainstream media about Bitcoin, they didn't even start to appear until 2011. And when the headlines did start, so too did the criticism, including from prominent executives like Jamie Dimon, who called crypto a Ponzi scheme and a fraud.
I'm a major skeptic on crypto tokens, which you call currency, like Bitcoin. They are decentralized Ponzi schemes.
You heard them. And the use case for Bitcoin, don't even get them started on that. And that brings us to our question of the day. What was the first recorded commercial transaction using Bitcoin as payment? The answer? Well, it came to us on May 22nd, 2010, when a Florida man used 10,000 Bitcoin, worth less than a penny each, to pay for 2 Papa John's pizzas. Those same 10,000 coins today would have a value of about $970 million. Now, that Florida man was no average Joe. He himself was an early Bitcoin developer named Laszlo Hanyek. He wanted to test the speed of transacting across blockchains. Now, since that fateful moment, now commemorated as Bitcoin Pizza Day, the cryptocurrency has, well, let's just say appreciated in value. It's up 2 million% or so since 2009 to around $100,000 today, giving the Bitcoin universe in just 16 years' time a market cap, Scarlett, of more than $3.5 trillion.
What I want to know is, what did that pizzeria do with the Bitcoin that the guy paid with? You know, did they hold on to it, or did they move it along as well? Because they're sitting pretty if they held on to it. From Bitcoin to blockbusters, Paramount Global, which of course owns CBS and MTV, and independent film producer Skydance Media responded to critics of their pending merger. They say the critics' filings are defective and lack merit. Paramount and Skydance disputed accusations and asked the FCC to approve their merger promptly and without conditions. Joining us now to discuss this and much more is Jeff Goldstein, AlixPartners co-head of America's Media and Entertainment Practice. Jeff, it's so good to speak with you. I guess we need to start with the Paramount and Skydance merger, because so much of what happens there kind of determines what the M&A landscape looks like for the rest of the media sector. Do you expect this deal to go through in its current form under the new incoming administration, or will there be concessions, maybe even significant concessions made to appease critics who are alleging some kind of media bias?
I expect this deal, Scarlett, will go through without a whole lot more friction. There might be a little bit of noise, but ultimately the deal is sound, and the company has quite a challenge in front of it. We're predicting the pay TV subscribers, which this business is very exposed to, will go down by the end of this year to $50 million, which is compared to 100 million subscribers 10 years ago. Mm-hmm. This is a huge structural change that's been underway, and they're going to have to continue it when they acquire the business.
Right. I mean, everyone talks about legacy media being a melting iceberg. Comcast and Warner Brothers Discovery, for instance, are separating their legacy cable networks from their faster-growing streaming businesses, setting them up for future deals. So my question to you, Jeff, is who's in line first to make a deal? Will it be other media companies? Will it be alternative investment firms like private equity?
Yeah, we expect there'll be at least one more cable TV carve-out beyond the Comcast SpinCo this year. We're seeing quite a bit of increased private equity as well as private credit activity within these disrupted TV businesses. And with the rise of private credit and their increased interest in the media and entertainment space, it wouldn't surprise us if the transaction actually turns out to be a big private credit investment rather than a private equity investment, but still an alternative asset investment.
It's kind of interesting, too. There's been a lot of talk here about how we could see more consolidation. A lot of people say we need it. The question is, will the government allow it? And we have an administration coming in that, at least on the surface, seems to be receptive to that. I guess the question, though, Jeff, is what does new media end up looking like? I mean, if the traditional broadcast networks and the traditional sort of cable setup is not our future, what is it? Is Netflix representative of that?
So Netflix is absolutely a part of the future. They've proven their success, and their push into live, which we saw again over the holidays, is a very big part of what we'll be seeing in the future. But interestingly, as direct-to-consumer streaming has had its experimental time, it's now going into the creative disruption and destruction time. We're projecting that 60 to 70% of all streaming subscriptions that are paid for this year will get paid for in some kind of wholesale way. Consumers don't want to have 12, 15 subscriptions. They want to have some kind of bundle. And so there's a bit of a reaggregation that'll be happening, whether it's corporates, whether it's joint ventures, or whether it's business arrangements. Consumers don't want to be direct to consumer with every single streaming service to get the kind of content that they're looking for.
Well, talk about that content itself, because that is going to determine whether we go down the bundle road, how we embrace it. I mean, I think for those of us who are subscribing to multiple services, we see how it's kind of broken up, and it's hard to find things. It's kind of hard to know where it's going. You have some sites that are still focused on original stuff, content, other sites that are focused on live sports and things like that. Is there a sense here that one of those will win out, or are we sort of going to be in this kind of niche world where it's all about catering to a niche audience, and in some way, all of those niches come together in aggregate to produce whatever revenue and profits these services are looking for?
We're expecting something like 3 to 5 big winners, but there'll be quite a market for niche. There was a market for niche in cable as well. So that's not going to be something that completely goes away. But you're talking about hard to find, and discoverability was a big theme last year at the Consumer Electronics Show. And as we go into next week's Consumer Electronics Show, I'm expecting discoverability to continue to be a big theme. This hasn't been solved yet, and this is a great opportunity for some, not just the traditional media players who have gone into streaming, but also for the tech disruptors to really get their R&D innovation engines pointed towards the idea of discoverability, because otherwise you're back to Googling the name of the show that you want to watch and hopping around your multiple streaming services to see if it's on that service this month, or maybe just was but has now moved away. That's not a great consumer experience, and so that's an opportunity for the businesses that are competing to go get a competitive edge and potentially be one of those aggregators, one of those bundlers in the future streaming wholesale market.
All right, Jeff, we have to leave it there. Got to get you back for a longer conversation. Jeff Goldstein over at AlixPartners, the co-head of America's media and entertainment practice, with the focus here on some of the potential changes we could be seeing in the media entertainment landscape here in 2025. Meanwhile, as we close out this Friday afternoon here on The Close, we're going to set you up for some of the big market-moving events for next week. Stick with us. This is Bloomberg. All right, let's take a look at what could move the market over the next week. We're actually going to start in Washington with Congress set to vote to certify the November 5th election results.
Yeah, with the red sweep, this will be an easy one. No controversy expected. Also, U.S. durable goods coming out. Yeah, then we move to Tuesday. We're going to get some labor talks involving U.S. dock workers. The CES conference begins in Vegas, and we're going to hear from Tom Barkin set to speak. Yeah, and of course, what they expect in terms of inflation, in terms of employment, with a big report due at the end of the week. We're also going to hear on Wednesday an interview here on Bloomberg with the outgoing SEC chair, Gary Gensler. Maybe, some regrets and maybe what he wishes his successor might do. We get FOMC minutes that day and the ADP jobs report on Thursday. A big focus on the life and legacy of Jimmy Carter. His state funeral will be held that day. The NASDAQ and the NYSE will be closed. The bond market will be open, though it will close early at 2 p.m. Eastern time. And all of that is to set us up for Friday when we get a big data point. The U.S. jobs report coming out for the month of December. Non-farm payrolls expected to increase 160,000. And keep an eye on what's been going on in the legal space. There's going to be a Supreme Court hearing on that pending TikTok ban, and the president-elect of the United States, Donald Trump, scheduled to be back in court for his sentencing in that New York hush money case. We'll be back next week. This is The Close on Bloomberg.